Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options S&P 500 US Market Update. Well, if you've been watching our recordings, you know that we normally try to inject a little bit of humor with our analysis and education. It's kind of how I live my life. Try to laugh every day. Laughter is good for the soul type of thing. But in all honesty, not a lot going on in the markets right now that's very funny. In fact, there's some things that are going on that are quite serious. Let's take a look at the charts and I'll show you what I mean. Back on September 30th, I did a recording entitled Beware the Repo Man, and I have a chart on the screen for you to look at. What the repo market is, if you're not familiar, is that's the market where if banks need liquidity to meet their requirements to close, they borrow from another bank. It's also a vehicle the Federal Reserve uses to inject liquidity into the Treasury market, so it's kind of has dual purpose. But when you see rates for overnight lending from banks to banks go above 8.5%, it sends shockwaves. The reason this is of a concern is this is what caused the great financial crisis back in 2008, is when the liquidity rates, the treasury markets just basically froze up. That's kind of going on right now, I hate to say. On Thursday, the Federal Reserve announced that they were going to inject $500 billion into the repo market on Thursday and another $1 trillion on Friday. $1.5 trillion in 2 days going into the markets because, as I mentioned, they were seizing up again. Again, not getting a whole lot of play on the networks because everything is consumed with the coronavirus and the spread, etc. And the thing that was amazing is it spiked the market. The market recovered about half of what it had lost on Thursday, and then they sold it right back down, even after the announcement of $1.5 trillion being put into the market. So that's kind of scary. The news over this weekend is, in fact, today, the Federal Reserve has slashed rates to zero. So here's the chart now. It shows you rates emergency meeting. They just basically cut them to zero. Rates are zero. They're saying that they don't see a market for negative rates. They're going to avoid that at all costs, but they just went ahead and said, forget it. We're not waiting until the next meeting. They had just cut 50 basis points in an emergency meeting. They expected another 50 at the actual meeting for March, but they just went ahead and said, we're going to slash this down, and they're starting with $300 billion plus in quantitative easing, another quantitative easing plan. You would think that the market might like that, but futures are limit down at the time of this recording on Sunday evening, which means that the market will open if nothing changes, and it hasn't changed since about 10 minutes after the futures market opened at 6 p.m. on Sunday, that will open at least down 5%. That's when the futures are limit down. So not looking like a good start. So if we use Thursday as a guide, sometimes the market kind of waits a day and reacts to what the Federal Reserve does. That's not unusual. I don't know why. It just seems to be the way it is, that the market doesn't immediately react and you get a later secondary reaction. Let's see if that happens in the markets. But for now, it's starting to get a little bit scary. So if we take a look at the chart on Friday, so there was the big down day on Thursday, even with the Federal Reserve announcing that $1.5 trillion going into the repo markets, and we came back, we closed that gap on Friday, which that's expected, but we still have a couple other gaps up here that haven't been filled yet. Those need to get filled, but this one at least did. We put the moving averages on. You can see that we have rectified some of the dramatically oversold conditions that we had on Thursday. We're still oversold, but not to the point where we were. But if we open down 5% plus, are we going to hit the 7% and have the circuit breakers kick on again and shut the market down? If nothing changes, it's possible. But that's where I was saying that it's starting to get serious. It's starting to get a little bit. The market, yes, the market overreacts. The market overreacts to the upside, it overreacts to the downside. But when you have something like this going on, where we're falling this far, this fast, the markets are usually telling us something, and it means that something bad is coming down the road, in my opinion. Worse than what we're fearing already. But I do maintain, and I want to make sure that I stress this, not everybody agrees with this. I agree with it 100%, however, is that the markets will bottom before whatever's going to happen with the coronavirus here in the U.S. peaks. Whenever the number of cases peak, the market will have bottomed before that. The market is a forward-looking discounting vehicle. It normally looks 6 to 9 months down the road. And so I'm convinced that we will bottom even as cases start to get a little bit worse. So let's see where we could go here. The next stop is our Katie bar the door level right here, which is the December 24th low back from 2018, and it certainly looks, and that's just like a pivot point V bottom type thing. It's not that significant of a support area, but it's the only thing that we have right now. I mentioned this to you before, that if we broke that previous Elliott Wave 4 level or previous 5 level, that we were coming down here, and that's exactly what happened, because there's nothing here. There's nothing to stop it. So this is the level that we're likely to come back to down here at the December 24th, 2018 lows. I don't even want to talk about, if that doesn't hold, where we might go, but that could be the thing that's really spooking the markets. But I can give you a hint. The next level is down here. There's a lot of support down in this 180 level. So that would be about where we're going to go if we can't hold in this area. So let's hope that that's going to hold, and that things maybe aren't as scary as they look. But the financial markets seizing up is worrisome. That's cause for a big concern. The Federal Reserve is not going to come out and just slash rates down to zero just like that, announce more quantitative easing, put $1.5 trillion into the repo market if something really bad isn't going on behind the scenes. I mean, just think about it from a common sense standpoint. Yeah, they want to get in front of this, but so far, I mean, with all the damage, we're going to wipe out, a year and a half's worth of gains. That's not the end of the world, but breaking this level and going down to 180, now you're talking about, multi-year stuff that you're beginning to wipe out, and that's going to hurt the average household significantly with IRAs, 401ks, those that are living on fixed income and things. It's just not a good scenario. And, we're closing everything. Sporting events have all been canceled. The CDC today said that anything above 50 people should be closed down. So are restaurants next? I mean, they're closed down in France and Italy, so are they coming here? Well, most decent restaurants have more than 50 seats in them, so I don't know. I eat out a lot, so that's not a good scenario for me. Again, not trying to make light of the situation, but we can't just be doom and gloom all the time. I wanted to show you the chart here of interest rates because slashing to zero, look, we have a nice wave 5 pattern. We've been in a wave 3 down. We bounced back up. We bounced back up and closed this gap. So there was a lot of gap filling that occurred on Friday. So we closed that gap. We're at this wave 4 level. Well, we're coming down tomorrow. So we're going to come really close to hitting that target just in one shot tomorrow, I think. So that whole wave 5 could be just a couple days the way things are going. I also wanted to show you the VIX. We came down on Friday, filled this gap here. So again, there's another gap. Remember, the VIX charts work just the way that any other security charts work. Some people try to say, no, they don't, but they really do. We've already talked about the explosion from the descending triangle. But the interesting thing with such a rally that we had on Friday, the VIX still closed at 57, and that kind of gave you an uneasy feeling over the weekend that stocks really recovered on Friday, and I'm hopeful that could last, but it doesn't look like it, at least at this point. Let's see what happens when the market opens. Do things calm down? Does buying come in based on the Fed's announcement today? Is it just the futures market that's looking so concerned, or is that going to translate into the equities market as well? We'll see. I also wanted to show you the dollar. This makes a bit more sense to me. We mentioned this before when the dollar was coming down. That was good. The fact that the dollar is spiking up is not so good for international companies because of the exchange rate, etc. But it makes a little more sense when you start to have a crisis, a global crisis, because the dollar is the reserve currency. It's viewed as the strongest currency in the world, and when things start to get dire around the world, money comes into the dollar. That's the way it's always worked, and it is working that way again, which means that at least money around the world is seeking a safe haven, which the dollar is viewed as. And so even though it may not be good for multinationals as far as the exchange rate, the fact that the dollar's moving back up, at least it jives more with what should be going on right now. And we're really stretching to find things that make some sense with all of the hysteria that's going on. And there really is. I mean, when you look at the amount of people that are sick, and you still go back and you hear the people comparing it to influenza, and the number of younger people that have died is nothing compared to influenza. None of that matters. It's contagious, and the fear factor is there, the hysteria, the fear factor. And so, you can think what you want about the seriousness of the virus itself. It's translating extremely negatively into the markets, and with what's going on right now, I've got concerns that we are going to be able to hold this level here. It's not that far away. That would be a good thing if we can come down and hold that level base for a bit. That would be the best case scenario. Now maybe we have a little bit of a short-lived period where we do some back and filling, some support building, and we get ready to move higher. There is some hope from some medical people that when we get into the summer months, the warmer weather tends to kill off viruses like this, or at least make them not so contagious and not spread as much. We're in March. The warm weather is not that far away. That could be the most positive scenario that we can look at right now. But we're certainly going to be interested to see how the markets trade on Monday. We'll be back to talk to you again within the next couple of days, I'm sure, to update you. Hope you've had a good weekend, even with everything going on. And as I said, I always say take care when I close this out. But in all seriousness, be safe, take care, be smart, and we'll talk to you soon.